Like all companies, corporations are required to have a financial statement which shows the change in the value of the business over a period of time. For a sole proprietorship or a partnership, this would be the statement of owner's equity. But corporations have way too many owners to have a proper statement of owner's equity. So instead, they will prepare a statement of retained earnings. However, this statement works exactly like a statement of owner's equity would work for a sole proprietorship or a partnership. You start with your beginning balance of the account, so retained earnings at the beginning of the period, and then you add to it any additions you would have to retained earnings. Well, what is retained earnings? It is the portion of a company's profitability which they have chosen to hold on to instead of distributing to their owners. So your addition to this would be your net income. And if you take your beginning balance of retained earnings and add to it your net income for the period, you get a subtotal, which is how much the company could have retained if they didn't distribute any portion of that income. Well, typically they will, and for a corporation that's in the form of dividends. So you subtract out your withdrawals to owners during the period by subtracting your dividends declared, coming up with your end balance of retained earnings. The statement of retained earnings is perfectly allowable under the generally accepted accounting principles, and for this course, that is the way that I am going to make you prepare an equity statement for the time being. However, that is only accepted by the generally accepted accounting principles that are used by American corporations. For a corporation that is set up any place outside of American borders, a European country, a Asian company, etc., they have to report using IFRS. And IFRS does not allow a statement of retained earnings. They instead make their companies prepare a statement called the Statement of Stockholders' Equity. American companies can use the Statement of Stockholders' Equity if they wish, and nowadays most have begun to do so. What does it look like? Well, a Statement of Stockholders' Equity shows the change in any one account over the period of time, but instead of just doing it for retained earnings, they display the number of shares of stock that are outstanding for each class, the amount that they are carrying attributable to par value for each class and how it changed during the period, the amount that they are carrying on their books which was paid in excess of par for each class of stock. This one only has common, but preferred could go in here as well. The changes to your retained earnings, which again is the amount of income less the dividends that you paid, the difference between those two added to your beginning balance to come up with your end balance, and ultimately how all of that changed during the period to change your overall stockholders' equity. I can foresee a time in the future where this becomes mandated by FASB, the Financial Accounting Standards Board that sets GAAP, but for now it's not. So I'm going to have you guys do the simpler statement of retained earnings, but please know that there is a different form of this, the Statement of Stockholders' Equity, which is used by the rest of the world, and I would not be surprised if we have to use it at some point in the future as well.